Hi everyone, welcome to another episode of Capital and Context with myself, Mark Insley, and with me again, Kate Berkshire Asset Management Portfolio Manager, Sam Hallett. Welcome, Sam.
Good morning.
How's your week been?
It's it's been a busy one. I'm sure we'll go over some of those points in a minute.
Yeah. So this week's episode, again, we're jumping around topics. Thank you for those who commented on the last episode around wanting sort of something away from developed markets. The feedback was appreciated. So we've chosen this week to dive into the exciting world of emerging markets. We won't necessarily define that as emerging market equities or emerging market bonds. We will sort of talk quite broadly about the space. Conscious on, in emerging markets, so many different components to them. So we will still try to keep to our episode length of about 30 minutes, Sam. So I know you can talk forever on these topics, but we want the snippets, we want the best bits for the audience. My first question is, what would you say is your favorite emerging market and why?
Possibly frontier Asia, actually. It's an area where you don't get an awful lot of analyst coverage, which is, means that you have potential to pick up quite a lot of alpha there. So that's always nice. But also they benefited an awful lot from the China plus one. So when we had the first Trump Mark 1, let's say, and we had the first load of China tariffs going on there, China companies had already had, as a result, started doing what's called the China plus one policy. So that's doing some offshoring of their manufacturing into other countries, and an awful lot of those frontier countries kind of benefited from that. But also, we're finding that their services economies are starting to pick up as well.
Okay.
So if kind of small markets, when they can rally really quite hard. So I think that's an interesting little subsector within global EM that's quite interesting at the moment.
Okay. Do you want to ask me what my favourite emerging market is?
I'm guessing it's not China. But what would your favourite, what would yours be, actually? Is it South Africa by any chance? Oh!
Just a quick change, everyone. Hold on. There we go. Thanks, Sam, for asking that question. Yeah, my favourite emerging market is South Africa. So congratulations to Bafana on making the World Cup. One
thing I think that we should point out for those who aren't on the video version, they're looking at the audio. Mark did have ready to put on an essay,
a bright yellow
SA football shirt. So thanks for brightening up this very dreary office today.
No worries. Right, back to business. The case of re-engagement in emerging markets. I think it's one of those areas that is either hot or cold in asset allocation. So why do you believe now, based on our conversations, why re-engagement might be a good time?
Yeah, so it's interesting you say that. I think it used to be more of a hot and cold allocation. I think for us these days it's a constant. I don't mean it stays static, but it's always there somewhere. The reason being is the great thing about global EM is you have the economies of the world that are more separated from others. So what that means is, one of the things very important to us as portfolio managers is that we're trying to find assets that aren't perfectly correlated, which was quite hard in 2025. Things moved very close together. Within global EM, Latin America, say, rate cycle is going to be different to India, very different.
Covers so many parts of the world.
So I think having global EM as a whole, you would certainly have an allocation throughout now the market cycle. I think that covers your point.
Yeah. And what sort of return? Obviously, I sort of know the developed market returns probably more to hand. What sort of return profiles were there in sort of general emerging market? and maybe a couple of market specifics.
Yeah, so MSCI, for those who aren't aware, is a pretty fundamental within our space index group. Their emerging market index was up last year, 34%.
Okay.
So way outperformed developed markets. So, but the reasons for that I think are different. So, globally very much benefits from a weaker dollar environment, and we spoke about this in a previous episode about our assumptions coming into 2026 was is very much a dovish, so a loose monetary policy orientated Fed, and there's a few other factors that kind of tilted into the US dollar having a bit of a weaker year this year. Globally, kind of everything kind of moves in advance, so to speak. As we know, a lot of our job is preempting the preemption of other people in the markets. That's how we generate our outperformance. So things rallied last year off the back of that, but I don't think that was the whole story. I think a big story was the fact that we're having earnings growth within these emerging markets now that is genuinely very, very good. And as I said, the services economies, these economies are modernizing. So historically, it would have been very much what's going on in the commodity space would translate across into what's going on in the global EM.
Yeah.
These days, things are becoming even beyond manufacturing.
I guess the technology and things, the gaps.
Even like Vietnam is becoming far more of a modernized economy. And one of the highlights for me last year was looking at, say, like Indonesia.
Yeah.
So it's a tiny one, but there's some really good names out there at the moment.
Okay. We have a long sort of history together of investing in China. We've had some wins and some losses over the years. Often a market that flatters to deceive when you think it's all there for a extended run. So it's often a market hard, I would say, to time, and perhaps a market to, as a result, be invested in. But obviously with the dynamic, tech focus, huge scope of the Chinese market, what is the bull case, the positive case for China, would you say, at the minute? And on a converse, what would be the bear case for China at the minute? Because I'm sure there's, as ever, differing views out there from your fund manager meetings.
So let's start with the bear, actually. I'll flip that on its head. So there is still talk out there about property being an issue. And for those who weren't aware listening in, so basically what kind of burst the China equity or markets generally, a bubble from end of 2021, was we had basically Chinese property developers were massively overbuilding compared to the demand that was actually needed for property in a lot of places. The reason why that created a snowballing effect was that Chinese consumers, Chinese citizens, their savings rate is very large, but where they were saving was they were putting it into bricks and mortar. Like a lot of people in the UK, feel that, it's a safe place to end up putting it. Thing is, what they were doing was an awful lot of people were buying off-plan properties, but there was never going to be a tenant to go in them.
Yeah.
So, when all of these kind of things started collapsing, fortunately, only figuratively, it really knocked a lot of the confidence of, obviously, Chinese investors are going to be a very large participant in their own market. It's taken an awful lot to get the whole system moving along. And the Chinese government have tried also to entice consumer spending just to try get that savings rate down a little bit, and just to help power the economy. After all, China's been suffering from pretty much 0% inflation for over a year now.
Really? Wow.
Yeah.
Whereas it was 9-12%. And the growth and stuff was almost double digit at one point, right?
Yeah, so that's the thing. Growth has slowed down. But I think an important thing to look at is kind of like looking at that versus, say, the CPI print or the Chinese equivalent. After all, you always take Chinese official numbers with a little bit of a pinch of salt. So yeah, things are slowing down, but you got to remember, China as an economy is maturing. You're not going to have those early EM growth periods. Like, a lot of people are saying India is like China was 20 years ago. I don't quite believe that analogy because the bureaucracy levels are somewhat different. But in India, you've still got like 7% growth. Obviously, as a maturing economy happens, that does tend to slow down.
Yeah.
Hopefully not quite as bad as the UK, though.
Yeah. And the bull case for China?
So very much becoming a more not so export orientated economy, which I think is in the long run probably a good thing. Obviously, there's some decoupling going on of global economies. We know this very well at the moment, but I think it's just hastened it. I think as China's matured as an economy, that was going to happen anyway. So the services sector is a really important one now to look at. So hence why software is becoming so much more important. Hence why last year when you had DeepSeek and they had like their own AI, it's like, oh, okay, so they can grow independently, kind of that thing. I think that was very positive. And when they have a 5-year plan, which was last year, the year before, and that was very much orientated again at like the semiconductors and all that kind of space. Well, if they can do semiconductors on the scale where they do, say, solar panels, like they will dominate the market. There's a lot of this and buts there, because whether they can have the same kind of efficiency rates and so on, there's another kind of fish. But looking at this year, talking about 15% earnings per share growth.
Yeah.
So quite bullish there.
And again, I think any market with a population like that, right? That's always been the thing with us, the potential, and yeah, I guess at some point it won't be classed as an emerging market. What point could that happen?
So there are.
Or is it already there? Is it just?
So this is the thing. It's that thing. The definition of an emerging market versus a developed market isn't necessarily the size. There's certain kind of like qualifying factors with regards to like rule of law, legal systems, and all that kind of element. So an example of this coming out from the upper way, going from frontier to emerging market, would be Vietnam. So that has kind of been given on the nudge, like they're probably going to be upgraded to an emerging market this year. One of the reasons why we hold. And, so it's that same kind of thing. You need the structures in place.
Yeah. Okay. That's useful. Conscious to try to keep India a little shorter, just purely because we're going to have our first external guest into the studio whilst I'm away on my emerging market research trip.
I think you need to do more than just South Africa.
Fair enough. So yeah, but no, India again is a market we've used in the portfolios for many years. Again, you've touched on the structural growth sort of story there of the sort of India sort of potentially. I agree with you, not 20 years behind, but another global economy that sort of seems to get stronger and more influential each year. So just talk, I guess, a bit about the kind of the structural growth story that is still there and makes India an investable market. Yeah.
So one of the things that is always quite interesting when you look at kind of like more modernization of global emerging markets is the urbanization rates. And that, so when people think of India, they always think of, like Mumbai or New Delhi, kind of like these huge places. An awful lot of the Indian populace, though, is rural. Farming is a really important part behind the Indian ecosystem. And what we're finding is that India's becoming more urbanized, and that means that you end up with a little bit more kind of like, obviously when people are located in closer spaces, they can work in larger factories, and so on and so forth, which means that, the efficiency of what goes on within the economy increases. So that's an interesting one. Also, India isn't suffering from a aging population kind of issue, and like 99% of the rest of the world. Chinese populations will actually start decreasing very soon. I think India, with, as I said, not having this age problem, not just that, you're looking at kind of like 7% real GDP at the moment, so very positive there. I think.
And the Prime Minister or the Governor Modi, what's the situation there? Is he is it still another couple of years of term, or he's been in power a long time? Is that a positive or a negative? From your perspective.
Yeah, so I think it's important to understand why investors quite like Modi, and it's been the closing down of more darker parts of the economy. And what I say by that is just more like closing off avenues for money laundering
and tax avoidance
and tax avoidance, which means that in theory, you can increase, obviously taxation is helped, but also the fact that it means that if your taxation is helped coming in, it also means that you can improve your government spending
and just general governance. And
exactly. Just bureaucracy in theory improves rather than becomes a hindrance.
Okay. Bringing things back to Cape Berkshire and sort of the 5 portfolios, could I push you for some sort of current portfolio positions, percentages in certain portfolios, or any emerging market driven changes you have made this year or have on your radar?
Yeah, sure. So when looking at what we hold within, we hold within our portfolios, so our passive VOIC only portfolios. We just hold Fidelity Index Emerging Markets, which is because it's cost effective, follows MSCI EM, so it satisfies those requirements. From a passive perspective, from our P portfolios, so for those who don't know, those portfolios are more of our flagship, kind of can hold actives, investment trusts, ETFs, OICs, etc. The whole works. We hold mostly Artemis Smart GARP Global EM. So the system, well, that's a good point in itself. It's systematic. So you remove a degree of bias from fund managers to a degree. Don't get me wrong, there's a human in the loop still, but it's rather systematic. But GARP stands for growth at reasonable pace.
It's the first time I've heard human in the loop used for
something that's not
management.
AI.
Yeah. Interesting.
So GARP, growth at a reasonable price, is a fun one, really. Because if we put our minds back to pre-2022, or everyone was just after growth, style, regardless of the price. People didn't really care, did they?
Yeah.
They would just go all out on growth. So the style that people are talking about more is more growth, but with a value overlay. And these guys have been doing that quite well for the last few years. Other managers are available. Should probably get them in for a chat at some point as well, because it's really quite interesting. But and also, sorry, I completely forgot, we hold a standalone holding in Dragon Capital Vietnam Enterprise Investment Trust as well, just because of, as we said, with that re-rating going on between from frontier to emerging markets likely to happen fairly soon.
Okay.
That's going to help flows come into the country, and also as a result, I think an investment trust style for Vietnam works a bit better, just because of you don't have to worry about SICAV rules, etc. Okay.
That covers the equity side. What about the debt side of emerging markets? Do we hold anything emerging market specific on the debt side?
Yeah, so we used to hold.
We won't have enough time to get into emerging market dets and hedging and local money.
Certainly.
So.
It's EM debt. I would just start off by saying I really think it's going to be a great space for 2026. It's somewhere actually I'm overweighting at the expense of other areas of fixed income. Reason being is that you're looking at yields are at a premium compared to developed markets, but yet the indebtedness of emerging market, let's just take sovereigns for example, emerging market economies, as in fiscally, I run so much more conservatively now than you would have looked like, say, in the late 90s when you had the whole Thailand thing, etc. go on. I think, frankly, they present fantastic value for money compared to developed market sovereigns these days. But within that, and not just that, the corporates, again, are excellently run with good earnings, growth going on, and conservative, fairly balanced sheets. Obviously, you need an active manager in there. It's not an area you want to be passive on at all, because you do need to look under the hood. But we hold Vontobel, emerging market debt, which is a bit more of a niche fund house. But again, if you're doing things right in this space, you probably are going to be a little bit more niche. And PIMCO as well, we hold in this space, both of which are blended. So one thing to put up for emerging market debt is you get two kinds. You kind of get soft currency, which is more like local currency. And you also get hard currency, so that's like emerging market debt issued in dollars, sterling, euro, etc. Okay. So we hold blended funds so that they can go across both.
Okay. And then if I take, rather than pushing you through every single portfolio, but what for those interested in asset allocation, what would, like in our portfolio one, what would be our maximum allocation you think you would go to in a real bull case on emerging market debt? And then the question the other way, perhaps in our portfolio 5, what would be the highest percent you think you'd go to in a multi-asset portfolio on emerging market equities?
Yeah, sure. So I would say EM debt.
I'm not going to hold you to these numbers, but
No.
I think more for an education perspective,
say,
what would people be targeting?
Yeah, so EM debt, I think you'd go for a real bull case perspective, like possibly even as high as 20, but in my head I'm thinking 15%. The reason being is you do have to be aware of the biggest risk in this space is political risk. So things can move quite quick.
Yeah.
So you don't want to go ridiculously high. Bear in mind that sterling corporate in portfolio 1 would be like 45% or so of the portfolio. EM equity on 5, I'd say 20-ish or so percent, which is very bullish. You think US equity makes up. It's come off of the high. The high was about 50%. It's close to 40 now, but so 20 would be bullish.
Sure. And for those that don't have access to fund managers like yourself, what might be a couple of tips on where people can learn more about emerging markets and what's going on in them from a sort of market movement perspective?
I think the exciting thing that happens within emerging markets is actually look at policy changes that goes on, because those are the things that are the drivers of growth.
And so would you say global news sites would
yeah,
still be the best source
I was going to say kind of global news. You'd probably find, and not that I am saying that other sources are available, but like the FT's kind of like world EM section is probably where I'd say keep an eye on that. You want to look at what are the longer term drivers. You think it's not EM, but look at Japan, how long those corporate governance reforms took, because people were talking about those like when I started working with you about 8 or 9 years ago, and it took a long time for those to actually drive things through in terms of increased earnings, etc. So it's more of those things that you look for the news and then almost like make a mental note. It's like, okay, this will take 3+ years, but definitely keep that in your diary to revisit at that point.
Okay. And then I think my final question, if you could only pick one emerging market, ignoring returns year to date, so sort of resetting at zero now and running to the end of 2026, if you were to put your decision making hat on, which one market would you back to be the one with the highest gross return for the rest of 2026?
For 2026,
just in that sort of
interesting,
because in that 9 month
window. Yeah, I tend to think I tend to think a bit longer term than that.
All right, I'll give you for over the next 12 months.
Thanks for that 30% increase.
If we were to look back at this, what would be your one pick from an equity perspective on index return? What do you think will be the winner?
I'd probably say Vietnam.
Okay.
With the caveat of I'd quite like to look at the Frontier Index.
Okay.
Yeah.
So you might take the Frontier Index over one particular market.
I just think Frontier is really exciting space to be in for the next couple of years.
Yeah.
And not just that, the thing that I think is interesting is emerging markets do have to tend to have a bit of a end of market cycle rally. It's where people are looking for a bit of value. EM is very good value compared to developed markets at the moment. And it also has that earnings growth story. And the exaggeration of EM is often Frontier. So I think it could be quite interesting.
Okay. Good. I think that's again been a sort of education of the places and the major features of emerging markets. Some asset allocation of what your minimum and maximums would be in that market. As I say, I think there's probably a whole episode at some point on emerging market debt, because it's a space I love going back over, and it's a complex space, but as a result, definitely a place where we always sort of seem to I think add value over the years.
It took us a while to get it right, though. That's the thing. It's something that definitely requires a lot of research and time to pick the right fund houses to work in that environment.
No, so we'll come back to that. But no, otherwise, I think it's been another good episode. Thank you for your time.
Thank you.
Let you get back to your desk and research and everything else. And next week's episode may well be our first Zoom or hybrid. You'll be here. I think I'll be on Zoom. And then an exciting episode with external guests starting now. We've had some really great feedback on the first few episodes, so we appreciate clients and people taking the time to listen and view this content, and getting some good feedback back. So we will continue on this podcast journey together, and thank you for your time, Sam.
Thank you.
Thanks, guys.